Dollar engineering versus hard asset consensus. Why 2026 will decide the winning asset strategy. Flint West reporting. They'll tell you this is about markets, stocks versus gold, risk on versus risk off, innovation versus stagnation. That's noise. What's really happening is quieter and far more structural. The world has split into two competing systems of wealth creation, and they are no longer compatible. On one side, you have the United States. On the other, you have everyone who no longer wants to finance it. This is not a moral story. It's a liquidity story. The US strategy is elegant, sophisticated, financialized to perfection. Take the stock market. The Magnificent Seven sit at the top like load-bearing beams: AI, cloud, semiconductors, platforms, a narrative of productivity, dominance, and inevitability. Take Bitcoin, not as bearer money, not as a neutral protocol, but wrapped, custodied, ETF'd, engineered into a compliant asset that lives inside US capital markets under US regulation denominated in US dollars. This is not accidental. Anyone who wants exposure to the upside, AI, tech, financialized Bitcoin, must first access the dollar. They must clear through US markets. They must support US liquidity. That is the design. Dollar engineering is about capturing demand and funneling it into a single monetary center. Every inflow reinforces the dollar. Every ETF share, every equity multiple, every recycled surplus becomes another brick in the wall. But here's the catch. This system only works as long as liquidity keeps flowing. Now look at the other side. Gold doesn't ask for permission. Silver doesn't care about ETFs. Cobalt doesn't require reserve currency status. Precious metals are mined everywhere: Africa, Asia, South America, Australia. They're bought in local currencies, held locally, stored locally. There is no gatekeeper. This is why the hard asset strategy scales globally. Not through leverage, not through derivatives, but through accessibility. Once a consensus forms, once countries, central banks, and populations agree that these assets matter, anyone can participate. No dollar required, no US custody required, no financial engineering required. That decentralization is often framed as a weakness. It isn't. It's the point. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Now bring China into the frame. China does not want to support US dollar engineering, not ideologically, mechanically. Recycling trade surpluses into treasuries props up US liquidity. Buying US tech stocks props up US equity multiples. Financing US innovation props up US power. So China opts out. They don't recycle surpluses. They don't chase US tech valuations. They don't need NVIDIA's stock to go up to execute their strategy. This makes the game mutually exclusive. Either the world continues funding US liquidity or it doesn't. Either the asset basket is supported or it fractures. There is no neutral middle. This is why liquidity, not narratives, becomes the decisive variable. Watch the US long end, the 10-year, the 20-year, the 30-year. High yields are not bullish. They are a warning sign. They tell you demand for US debt is thinning. They tell you rollover risk is rising. They tell you the system is being forced to pay more to survive. And survival is expensive. Over $9 trillion in debt needs to be rolled. At the same time, AI infrastructure is being built with leverage. At the same time, markets expect support. At the same time, politicians refuse austerity. Liquidity can't do everything, so choices get harder. Now add the hidden fault line: housing. US housing isn't crashing, it's frozen. The 10-year is too high, mortgage rates are punitive, buyers can't buy, sellers won't sell, inventory piles up quietly, sentiment collapses regionally, price discovery is delayed, not avoided. This is what liquidity stress looks like in the real economy. Housing doesn't fake it. It doesn't trade on narratives. It responds to rates, and rates respond to debt. A frozen housing market is the system saying this equilibrium is unsustainable. Then there's the money market problem. Roughly $7 trillion parked in money market funds, yield-sensitive capital, restless capital. If short-term rates fall too fast, that money moves. If it floods into risk assets, inflation reignites. If it stays put, growth suffocates. The Federal Reserve is boxed in. Cut too much, inflation returns. Hold too long, something breaks. And all of this is happening while foreign holders quietly reassess whether US debt is still worth the trouble. If Japan is forced to defend its currency, if the yen carry unwinds, if treasuries are sold to fund domestic stability, liquidity shrinks again and again and again. This is why 2026 matters, not because it's a calendar year, but because constraints converge. Debt rollover meets AI capital expenditure. Housing stagnation meets employment lag. Global de-dollarization meets domestic leverage. At that point, the question becomes unavoidable. Can dollar-engineered assets survive without continuous global participation? Or does the system reveal that it requires constant external funding to remain stable? Hard assets don't have this problem. They don't promise yield. They don't require leverage. They don't depend on foreign goodwill. They only require consensus. And consensus is spreading. So this isn't about being bearish on America. It's about being honest about mechanics. You can't financialize the entire world forever. You can't gate global wealth behind one currency indefinitely. And you can't rely on liquidity that others no longer want to provide. 2026 won't decide which assets are exciting. It will decide which ones endure. When access becomes the constraint, when liquidity becomes political, when participation becomes selective, the winning asset strategy won't be the most innovative. It will be the one that doesn't need permission to exist. Flint West signing off.